Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. The winter for funding in the startup sector, as the terminology goes in this industry, has certainly set in. The zest with which we saw funds inflow in 2021 had started somewhat declining in the year 2022. PwC India, in a recent report, had said that late-stage deals and growth-stage deals had seen an impact because of the global slowdown, but the industry was fortunate to see early-stage startups still attracting investments from investors. In the report, PwC India says that this segment, or the early-stage startup segment, saw funding growth of almost 12% in 2022 as compared with 2021. As of December, there were more than 1,800 funded startups in India, a base that has consistently grown during 2022. Arun Natarajan, founder of Venture Intelligence, says that as we move into 2023, a couple of trends are evident. One, he feels that the funds inflow into the startup sector won't dry up. And two, the focus for investors will shift from B2C to B2B. And we'll see in a few minutes what that means. All of the data that you'll see in this video presentation is from Venture Intelligence, which is a data research and analysis firm focused on private equity and venture capital. But before we gaze into the crystal ball to see how the future looks like, here's how the wonderful days of 2021 panned out. At a time when the cost of funds was low and the US Federal Reserve raising interest rates was not even on the horizon, funds were there for the asking. Pension funds had cash ready for disbursement, for example. And it was almost like the LPs and GPs, or industry parlance for limited partners and general partners, to just pick up that cash and go around investing in startups. Mr. Arun Natarajan points out that even conservative entrepreneurs began accepting sequential rounds of funding one after the other, just months apart. He cites the example of a highly conservative company that raised $125 million in one round and within a few months accepted the next round of funding at $250 million. He says there's no way the company, which is highly conservative, could have burnt all of the $125 million before the next $250 million came up. Let's have a look at the numbers as they panned out. The chart here shows how, over the 4 quarters of 2021, there had been a rise to a crescendo, continuing somewhat into the January-March quarter of 2022. And then the slide is evident, both in the number of deals and in value. The downshift is evident from the last 2 quarters ended December, which together don't add up to the investment value seen in just the final quarter of 2021. But the overall funding momentum of 2021 had indeed carried on to 2022. 2021 by itself was a record year. 2022 was still the second highest ever. A 5-year trend is evident in the chart as shown. What's a conversation around startups without the mention of unicorns? For those new to this startup terminology, unicorns are those companies that have been valued at $1 billion or above. This is supposedly meant to compare these companies with the rarest of rare sightings of this mythical creature called unicorns. But in the startup sector, unicorns aren't that rare anymore. 2021 had a count of 44 companies that had turned unicorns. 2022 had 21 companies. This is less than half the number seen in the year 2021. But even then, 21 is a large enough number. Let's take a look at how the funds flow behaved in 2022. If you look at data from Venture Intelligence on the top PwC investments in the year 2022, we see that Qatar Investment Authority infused about $1.5 billion in Bodhi Tree. Yes Bank attracted $1.1 billion from Advent and Carlyle. Interglobe Technologies, which is in the business of BPO and travel, got about $810 million from Baring Asia. What lies ahead? Mr. Natarajan concedes there will be pain in the upcoming months. If you're a data enthusiast, you will know that the base effect will kick in soon. Come April, you will have the figures for January-March 2023, which will likely compare pretty unfavorably with the January-March 2022 figures. Mr. Natarajan is also quick to point out, though, that things are not so bad as to justify a panic situation. Why? First off, he says there's plentiful money that had been raised in 2022 waiting to be invested in firms. If you look at the data, there were 71 fund closures in the year 2022 that had raised an amount of $10.5 billion. This compares with about $4.6 billion over 54 fund closures in 2021. And it's a good bet that of the 10.5 raised in 2022, there's still a good portion that is still waiting to be invested. Here's a look at some sample data to show which funds have raised how much. Sequoia Capital has raised $2.85 billion to deploy across startups in India and Southeast Asia. Of this, it has learned it will use $2 billion across its India venture and growth investments. This apart, Eversource Capital, Elevation Capital, Axel India, and Kotak Investment Advisors, for example, have together raised more than $2.7 billion. How will 2023 be any different? First off, investors are bound to be far more conservative than they were in 2021 or even 2022. Sequential rounds of funding that are only a few months apart are unlikely to take place this year. Second, as we mentioned before, the shift for focus of investors will be from B2C to B2B. For those new to this game, B2C is business to consumer. An example is a car manufacturer selling cars directly to consumers. And B2B is business to business. And in this context, if the company is a tire manufacturer, it sells to the car manufacturer these tires to fit out into cars. So the tire manufacturer sells to another business. So that's B2B. In the context of technology investments in the startup sector, consider two examples. One is a software development company which provides software services and products to an online e-commerce firm. The online e-commerce firm sells directly to end consumers or end users. So the software development company in today's context may be far more attractive to investors than the online e-commerce firm because the latter sells directly to end users, and that's B2C. The trend of B2B as a preference started showing up in 2022 with 412 deals versus 389 in B2C. Compare this with the 2021 figures where you had 396 deals in B2B and 461 in consumer-oriented businesses. In 2022, the difference in quantum of funding was minor. $1.9 billion went to B2B and 1.8 went to B2C. Here's the third trend that you could watch out for. Founders and early employees of older startups who have part sold their shares in their own funding rounds will use their cash to invest in newer startups. That's something we've already seen starting to happen in 2022, and there will likely be a rising trend in 2023. The final pattern to watch out for are a couple of specific sectors that seem to have earned the glad eye of investors: biotech and pharma at a clutch, and deep tech. Let's take a look at how investor interest in the biotech sector has grown. As with most other figures, 2022 was still higher than 2020, while 2021 acts as the outlier. Starting from 2018, this trend peaked in 2021, dipped a bit in 2022. The 2022 figure of $1.9 billion is still higher than what was witnessed in the year 2020. For investments in deep technology, instead of just data, we bring you some insights from an investor who's made some very interesting bets. Vishesh Rajaram of Specially Invest says that 60% of his fund has been dedicated to deep technology, of which he has divided them into three buckets: climate, industrial automation, and space technology. In our own Business Matters series, we've covered quite a bit on climate and maybe some bit of industrial automation in the context of 5G spectrum and all that. But space technology? Why space technology now? We asked him, and this is what he has to say.
I have to be honest, we did get lucky on that sector. I can't claim to have seen all of this come through in the manner it has come through. Having said that, there is also some science to reading the tea leaves. And the tea leaves are as follows. Any sector has its first generation and then the second generation. And often the second generation does better than the first generation. Space tech in India did have its first generation between 2012 and 2016. Most people didn't know about it, me included. But there were a handful of companies that tried different things, didn't go too far. Most of them wound down, some of them still exist doing other things. Some of them evolved to being services companies, and so on and so forth. I think often for industries to flourish, the environment and the ecosystem needs to be mature. And for space tech, the timing was perfect for it to be now. Reason being, one, launch, access to launch or access to space was increasingly getting democratized thanks to SpaceX. That resulted in the cost of launch coming down. Thanks to a lot of the Europeans, making satellite was no longer a Herculean task which only the government and the universities knew. Making satellites became a lot more modularized, which meant the technological threshold to making a satellite and getting into space was not impossible anymore. It was very much possible by competent people. If you look at this and envision the future, you will notice that in 5 to 7 years from now, there will be a lot of satellites going out there that are using both communication as well as data of Earth in a fairly significant manner. I would not be surprised if I have the ability to use Earth observation data on my cell phone for a bunch of consumer like activities. A precursor to that will be the fact that industries, be it risk, insurance, banking, finance, commodities, all of them will also begin to use data on Earth in a fairly significant manner. When you look at this industry with this vision and this background, then you tend to start to believe that innovation can be done out of India as well. Reason being, ISRO is a very highly reputed, very highly capable space agency organization that is delivered in the past, and hence there is advice, resource, and support that is very valuable. Talent for aerospace, even at a junior level, is available in this country in reasonable size and quantity. And such sort of innovation can be done very efficiently in from a country like India.
Mr. Rajaram also points out that you don't need tons of money to get started in a space venture. He cites the example of a portfolio company of his, Agnikul Cosmos, which builds micro and nano satellites, where he says the first round of funding that Specially participated in, they didn't require more than $500,000. He says you do not need a minimum of $5 million before you can get your project off the ground. Specialty's other investments in the space sector are in Astrogate Labs, which enables high-speed communication for satellites, GalaxEye, which aims to shape the future of satellite image acquisition by launching an advanced constellation of Earth observation satellites in space, and Kava Space, which organizes the world's satellite data to help make it universally accessible, queryable, and useful. One can't wind down a discussion about startups in today's context without talking about edtechs, or educational technology companies. Funding for this sector declined 54% in 2022 compared with 2021. In 2022, half of the money raised by the whole sector was accounted for only by Byju's, which raised about $915 million. This was followed by Upgrad at $225 million. For a while now, companies in the edtech sector have been receiving flack for poor services, abrupt layoffs, and even restatement of finances, as in the case of Byju's. As the pandemic set in and peaked, the fortunes of the edtech sector peaked alongside. But with the receding of the pandemic, the sector has taken a bit of a hit. There are still those who swear by the model of the sector, but there are others who say that an online education model is no match for a student inside the classroom, face to face with a teacher. Only time will tell if there is enough steam left in the arena here. To conclude and sum up, here's what the coming year looks like. The figure of opportunity is similar to a barbell. Mr. Natarajan says at one end you will have vibrant startups still continuing to attract the interest of investors. And at the other end of the spectrum, you will have late-stage big buyouts of companies that have proven business models. But if you're a company that is in the middle, which is yet to prove your business model but needs funds, then it's going to be in for a rough time. That's all we have for now. Tell us what you think of the startup sector in the comments below. And till we meet again, have a lovely week ahead.